think one of the toughest questions for a lot of founders is how to finance their companies. I think on TechCrunch we oftentimes talk about raising venture capital, big rounds. We talk about SoftBank incessantly, hundreds of millions of dollars here. But there are a whole diverse set of choices that every founder gets to make as part of building their company. And so I'm super excited to bring two Atlanta-based founders here onto the TechCrunch stage to talk about how they went through the choices of raising a company. On stage right, all the way, is Katherine Petrolia, COO and co-founder of Kabbage, a real-time cash management platform for small businesses. Kabbage has raised more than $400 million in primary equity capital, venture capital, and has also deployed more than $8 billion in debt financing or debt in the cash flow solution for small businesses. Next to me is Ben Chestnut of MailChimp, CEO and founder, a marketing platform for small business, who's bootstrapped the company for almost 20 years?
19 years.
19 years.
Yeah.
And last year had 600 million in revenue, and I was told highly profitable, which is a phrase we don't often hear on the TechCrunch stages these days.
Right.
And so we wanted to do a kind of a special panel here, just kind of showing the differences in the approaches that the two of you have taken. So I want to start out. You're both from a place that I have been to, in the sense that I've been to the airport, and it's a good airport. But what was it like to to grow your companies in non-San Francisco City?
Go ahead.
It was, I was working at a media company in April 2000. It was a .com. We all got laid off, and that's what got me to start my company. And back then, there wasn't a lot of VC money to go around. So we just kind of had to hunker down and build our business sort of the old-fashioned way. So there really wasn't an option until maybe just a few years later. And I think that Atlanta was a great city to grow our company. It's a company with a lot of iconic brands like Coca-Cola and UPS, CNN, and I think that influenced the way that we grew MailChimp too. We always thought about MailChimp as becoming sort of an iconic brand as well. And it's a very creative kind of culture in Atlanta as well, with the film industry there and the music industry. So I've never thought about growing MailChimp in any other city but Atlanta.
Mm-hmm. We are often asked, why Atlanta? Why do we start this company in Atlanta? And we were just like, because we live there. So it seemed like the right place to start the company. But even 10 years later, after you started your company, there was still no money. We joke all the time that if you want to raise money in Atlanta, you should make Delta your silent partner, because you'll need to fly somewhere to get money. And we did. Almost all of our capital has come from San Francisco, well, actually, now it's all international dollars, but in New York, those are the places where the capital was available. We couldn't find the capital in Atlanta. But it's a great place to grow a company, regardless. It's a very diverse, very rich, very welcoming and warm culture. There's...
That said, though, we don't want to see a lot of West Coast company move to Atlanta.
It's terrible.
Yeah, don't go there.
It's a terrible
It's great, but you don't want to go there.
Don't do it.
Stay here.
I hear the real estate prices are actually really expensive. The studio is $5,000.
Crazy.
So let's backtrack. You're starting the company. You're starting to get the product out. You're starting to think about growth. Like, when did you actually make a decision about how you were each going to finance your companies?
I think it's genetic for some companies. Some companies have the ability to do that. I think everyone would rather just start their company and not need investors and do what they want to and make their own decisions and not be beholden to the investors or the board that they comprise. But we were a very capital intensive business. We had to raise equity in order to build the product that we wanted to build. So we didn't really have a choice. You know that you're giving up control of the company, and you know that you're giving up your ownership in the company, but it's the only way really forward for a company like ours.
Right, you're lending money. We are not a capital intensive. We send emails. We're a software company. So for us, we started in about April 2000. It wasn't until about 2007 when VC started knocking on our door. And even then, cloud was very new. SaaS wasn't exactly widespread, and they just really didn't understand our business model. They didn't understand the SaaS side of it, and they really didn't understand serving small businesses with SaaS. So we did have a lot of VCs come and visit us. They just didn't understand us. So maybe that's when we made our decision, well, we'll be doing this alone.
What do you think is the difference between financing through equity and financing through debt versus for bootstrapping?
I mean, for us, we've just been very lucky to always be growing very fast. We've never needed to raise any kind of financing or debt. It's really good now. We've saved a war chest over the years, preparing for our Act 2 of our business. We could go and get some debt if we wanted to. We've just never needed it.
I think Ben just has a lot more money than I do.
What do you think about equity versus debt? I mean, so you just brought up that you also haven't taken debt, which a lot of people maybe don't want to deal with venture capitalists because there's board seats involved and there's all this fundraising aspect, but that's a different thing. I mean, you're a SaaS business, you have cash flow, like it's easy to have collateral, you probably could handle the covenants decently well. Like, why not debt?
Well, you want to avoid debt. Am I too old-fashioned? Is this a trick question?
I don't know if you fit on this stage, but
you tend to not want too much debt if you can keep making your money and you don't need it. Yeah.
I would say our
Debt bad?
economy runs on debt.
Yeah.
In fact, one would argue that that is what drives a lot of economic growth in our economy, in our country, for sure. So I think that there is an argument for both. Surely our parents told us, like, you never want debt, that's terrible. But I think it's actually...
I think that old-fashioned sort of philosophy guided me a lot, and I think that was what, I wanted to run my company my way, and I think that I was building kind of a unique brand, and I really just didn't want a lot of people to interfere, and we were just making cash flow.
When you think about, in the context of your business, do you think about the speed of growth? Have you ever been constrained either by having too much capital, too little capital? Like, did you ever worry, God, I raised all this hundreds of millions of venture capital for Katherine, and I need more, and I need it now, and that's like the block for me to grow more. And on your side, I mean, have you ever been in the situation where you're like, God, if I only had $100 million a day, I would have been able to take advantage of this opportunity or something like that?
I think for us, we always had this bias towards speed. We were always moving very fast. I characterize our early years as running with scissors. We were too fast in some ways, and hindsight's 20/20. If I look back, I think that if I had taken money too soon, some people think, wow, they're emboldened by it. They hire a lot of people. We ran lean, and that actually helped us go faster. In our early years, we would take pride. We had an internal metric, 1 engineer per million users, and that scaled really well up until about 8 million users, and then we had to start hiring. So I'm kind of glad we didn't take it too soon. We probably would have overhired too soon.
I don't think that's been a challenge for us on the hiring front. If anything, it's hard to find people, and especially depending on where you're located. We have a small office in San Francisco. We were talking about this earlier. It's so hard to grow an office here just because of the transient nature of the workforce. But for us in Atlanta, I think it's always a challenge to find the right people who are going to share your values and are going to want to work hard and work fast. And we've stayed lean, I think, for the organization of our size with the amount of revenue that we generate. But you're always thinking to yourself, I wonder what that person's doing over there. They left at 4. Did they leave at 4 every day? I mean, you're always wondering if people are really working hard.
Yeah. That's why I leave my Slack status on as green at all times. But good tactic. That's what you learn on the TechCrunch stage. But I want to go back to, so you're talking about hiring, whether it's in San Francisco or in Atlanta or any other city. Obviously, every employee wants to look at a company and see success. Right, they want to see the totems of success. This company is, fundraise a certain amount of money. There's certain advisors around the table. How do you think about that, either for bootstrapping or the way you thought about fundraising in terms of hiring?
Well, I'd say for us, it helps that our brand is very well known, and we have a really generous profit sharing program. We put 19% of your salary into a 401k, and then we'll do an additional 6% matching, so that's about 25% of your salary that goes into your 401k, and it's immediately vested. So that's usually a really nice recruiting point. And there's sort of a magical thing with MailChimp where interns come in and they realize, wow, I'm writing code and I push it live and millions of people get to use it immediately. It's not going to the enterprise. It's not going to go to like a handful of really big clients. So that's really rewarding and purposeful as well. And so we've never really had too much of an issue with hiring.
we've always said somebody needs to be in pain before they hire someone else. There needs to be a real need for that person.
Yeah.
And it's not just about building a kingdom, but it's about somebody having an actual full-time job and what's the outcome that they're going to create. If you hire this person, there needs to be some work, some outcome associated with it, whether it's revenue, whether it's engineering output, whatever the thing may be, and we try to hold to that.
So this is a question from the audience, but when you look at your competition, and both of you have competitors in the marketplace who take their own funding approaches. I mean, how much have you chosen your model in contra to the competitors in your space?
You want to take that?
I think most of the folks in my space have definitely taken on equity capital as well as debt. It's just a necessity because even though we've deployed $8 billion and raised $400 million, but we had to keep a big part of the, like if we deploy $8 billion, we're going to keep a lot of that on our balance sheet, 5%, which is a lot of capital. So I think that drives the necessity to get equity investments. I think everybody is in the same boat when it comes to lending in particular. There aren't a lot of other options unless you just happen to be a billionaire when you start your company.
And let me follow up real quick on that. Is capital a moat in your industry? Like, is just raising more money a competitive advantage against others in your space?
It is, actually, because you can grow faster. You can spend more money on marketing. You can invest in your brand. You can build better products. You can provide more capital. There are a lot of different things you can do with money when you have it. It can really be an accelerant for your business. And that has been how we have used it. And in fact, when we talk to investors, we always say, this is what performance would be like without the capital, and this is what it will be like with the capital. And ideally, there's a pretty big delta between those two lines.
A little bit different dynamic for our business. I've been at this 19 years. So I've had waves of competitors taking in funding, and I've gone through those stages of grief where I say, oh my God, they're going to kill me now. And then the funding seems to get bigger and bigger, and nothing really ever seems to happen. We just keep a laser-like focus on our customers and building a better product than our competitors, and we're good.
Going way, way back, another audience question. You're just starting out. You're just the first, think first employer, maybe you're just the co-founders. How did you fund the first few days or months of the company's existence? Did you use your own personal credit cards? Did you, get a loan from a bank? Like, how did you get those first couple of months out of the way?
Well, first and foremost, have a wife who's a nurse. Health benefits. She funded us the first.
A lot of health benefits, yes.
Yeah. So it's not just me. And we ran a design business on the side. We were consulting, and that's where we got the idea for MailChimp, by listening to those customers.
Oh, interesting.
They all needed email marketing.
We're almost the opposite of that. My husband's been an at-home dad for 19 years, and my co-founders, Rob and Mark, they have a similar situation. Their spouses were at home. So we didn't get paid for a long time, more than a year, and we were funding it ourselves. Credit cards were a big part of that before we were able to raise capital. So certainly we understand the plight of being a small business and needing capital, but that's not our origin story.
Mm-hmm. And if I recall correctly, you were started around the financial crisis. Is that?
Yeah, it's a really smart time to
you actually, the commonalities in your companies are you both started in Atlanta. You both started during a financial crisis, just a different financial crisis.
Which crisis? Be more specific. Yeah, a bunch of them. Yeah.
But did that put stress on the business? Did that pressure you to go really fast in terms of you're burning credit cards. You have a certain spending limit basically in terms of the cash flow for your business.
There's a lot of pressure. I look back and I just think to myself, how did we eat for that year? I really don't remember how that all worked out. But
ramen noodles. Yeah, when you're saying go back to the early days, I was literally thinking, yes, ramen noodles, yes.
They're delicious.
Yeah.
For you, doing a consulting business, one of the things that, you didn't raise VCs, so you never had to have that kind of conversation, but one of the challenges with a lot of VCs is they say, you're a services business now. You're coming from a service mentality. There's no product here. There's nothing repetitive. Like, how did you safely kind of move from, we're doing client work to moving towards a repeatable product?
That was the hardest transition we ever had, actually. It took a year to get my co-founders, for all of us to feel safe enough to transition, because you're going from a place where you're making $20,000 per project or $50,000 per project to $5 a month for a MailChimp account. Mm-hmm. And you had to get MailChimp to get to sort of a critical mass. Even then, the only thing that worked was any revenue that MailChimp made for the month, we would just immediately cash it out and put it in our pockets to feel like it was real. And then every month it kept growing, the wad in our pocket, and we said, okay, that's the business of the future. Let's shut down the other business and transition.
That's amazing. Another question.
It's a tough mental transition to go through.
Another question from the audience. How did you think about your dream early on? Like, what was sort of the 10-year horizon dream? Did you have a 10-year horizon dream? Was there like, God, I'm going to be on this stage at TechCrunch, multi-billion-dollar companies, or what was sort of the thinking when you first started?
I don't personally operate that way. I'm not a big, what's my 10-year vision kind of person. I was an English major. I was in grad school studying to be a literature professor. So I could never have charted this path. But I will say what did motivate us a lot was we wanted to prove people wrong. There were so many people who said, that's a dumb idea, it's never going to work, we're not going to give you money, you guys don't have the right experience, you're too dumb, like you're too old, whatever the things are. And so it was really, we were really driven by proving people wrong. One of my favorite things is when, it's going to sound super narcissistic, I don't mean it that way, when investors come up and say, oh man, we're so bummed we missed out on Cabbage. And I'm like,
yeah. I'm also similar. I didn't really have that 10-year plan. For us, it was just how good it felt to help each and every small business. We were there working with them directly, and they would say, oh my God, you saved us. We wouldn't be here without you guys. And that was just very fulfilling for us. We didn't really have to think much further than that.
I'm going to ask two different questions to each of you. So for Ben, obviously VC started reaching out to you, maybe 7 years afterwards, but they did start to reach out. Did you take those meetings? How did you sort of handle them? Did you just say no to every VC who came up? Did you sort of take those meetings? Did you ever go down the line with any of them?
No, my philosophy was always, it behooves you to talk to people who had access to lots of money. So I opened the door for all of them. I talked to every single one of them. I've become friends with a bunch of them. We talk about tacos and stuff. They visit Atlanta, we go out. Yeah, there's...
Taco capital of the world, I hear, yes.
Right. I've made good friends with them.
But really, the studios are really expensive, so you should go to the taco capital.
But now, the VCs don't come as much. Now it's more like bigger private equity type companies, and they come knocking, and now they just ask different questions. They say, how's your health? They're kind of waiting for me to keel over or something. Come in and take it from me, so...
And for Katherine, obviously you raised venture capital a couple months into the company. How did you feel about each additional stage of venture capital? I mean, did your approach or your sort of, the way you thought about venture capital change as you raise more and more money?
It's always relief at the end of every round. You're just like, thank God that is over, because it takes so much time. It really is a distraction. If I'm in Ben's position, I'm saying to myself, wow, if you think about how much time we have spent raising money, how much better might that time have been deployed in service of the organization? But you can't do it because you need money in order to grow. So it's sort of a necessity, not something that's just nice to have. But certainly I think it's really every time you're like, thanks for the money, I'm so glad it's green, we're going to use it.
This is a question for Ben from the audience. If you had to do it all over again, and you had VC resources available, would anything have changed in the way you did your business?
I probably would have. I ran lean for many years, and that spreads people very thin, and you burn people out. And I still remember people. I still remember their faces working really hard. I probably would have hired just a little bit faster than I did. Yeah.
And let me ask, even though you haven't raised venture and you're raising a ton of venture, I mean, do you have different approaches to think about the public markets? I mean, you're both certainly in the advanced stages of a startup. Certainly from our perspective, obviously, we have people in Battlefield who are 2 founders and a deck right now. How do you think about the public markets, particularly today with all the ups and downs in our industry?
I don't think about the public markets. I like to think about my business long term and think in terms of years. I couldn't fathom thinking about it quarter to quarter like that. I could never see myself as a CEO of a publicly held company.
I'm grateful that I don't have to think about it right now, and there's not a lot of pressure. At some point, there will be pressure for an exit. We have a lot of investors. We're fortunate that they're not harassing us right now to enter that market, but I think it's, speaking of distractions, it's a significant distraction. And the market isn't tolerant of investments and growth. Not everyone is Amazon, everyone is Jeff Bezos, and so you can't say, you know what, we're just gonna not make our numbers this quarter because we're gonna invest in new stuff. That's not something that is well tolerated by the market. And so I think that's a real challenge, and I think that's why there are some really large investors making big investments in high growth companies to give them an opportunity to have more runway before they have to do something like that.
There's this pattern, there's more and more secondary sales, particularly for early employees, for employees who've been around for a couple of years, where they sell some parts of their shares. How do you think about early liquidity in both of your models? You don't really.
I don't. So probably Katherine.
It's been a useful tool for early employees for us because they have been able to get access to, liquidity from the equity that they've received. We give everybody equity, whether it's, someone who's in an entry-level role or they're in our Bangalore office or whatever it is, everyone has access to that. So it's really demotivating to have a bunch of equity that's held captive. It's really useless to use. So I think it's a really useful tool for people. And the nice thing is they get to see the actual impact of their work. They can see, well, the company is worth this much more because of our efforts. And if we achieve our goals and meet our objectives, then the company's going to be worth that much more. And I'm going to see that when I'm able to sell stock next time. And if they have to wait until you go public, then especially now, in light of how companies are waiting longer to go public, they're like, whatever, that's never going to happen. Why do I care about that equity at all?
Mm-hmm. I want to address, this is a question from the audience, the culture that you build at your own startups. You're taking very different approaches, different growth approaches. How does that sort of trickle down into the day-to-day of the culture of your two startups?
Well, for me, when we talk about, I have friends who run publicly held companies, and I had dinner with one recently, and I said, I'm taking my leadership team to an offsite. We're going to talk about mentorship and coaching and sort of their leadership path for the next maybe 5 years or so. And the conversation went like this. He said, why the hell would you do that? You're not going to know them in 2 years. And I was like, what do you mean in 2 years they're going to be gone? He was like, yeah, you just replace them. It was sort of like a farm animal mentality. And I just thought, no, that's not the way I roll. I want to know these people and I want them to grow with me. So that's, when it's privately held and self-funded, you can kind of, I won't say take it slow, but you can maybe be a little bit more conscious about the people in the company and your culture. You're not always in a constant race.
I find it to be a delicate balance. Culture is always very important to us. We care a lot about, what our employees say about the culture and what they think, and we make them a part of it, and we invest a lot of money in it, frankly, and time. But there is this really hard balance where you really care about the people who work for you, and you care about their career growth. But sometimes, especially if your company is growing really quickly, it's hard to make them see that they have a career path. They don't realize that their career is growing because the mountain is moving underneath them, not because they're moving higher up the mountain. They necessarily are. So helping people understand that is really challenging, and I think people sometimes at a company at our age and at MailChimp's age, they feel like they need to go do something else, not realizing how much their career has actually grown doing the same thing or something similar to the same thing. But it's hard. It's really hard because you want people to feel like they're growing, and sometimes a new role or a new title does that, but it's not necessarily the best thing for the company.
And specific question from the audience around marketing. Obviously there's different ways to market. Oftentimes it's really expensive, right? You have to just put a lot of money into Facebook ads or different other channels. How do you think about marketing given the way that you grew?
We spend a shitload of money on marketing. We always have. My co-founder always says there's 1,000 shitty ways to market to small businesses, and we have to be good at all of them. And we've literally done all the things. We have these really funny television ads that we're relaunching right now with Gary Cole that are really funny. So that's been our new thing, but we found radio to be super effective. We still do direct mail, which annoys me because I cannot stand getting direct mail, but apparently it's effective. Email, marketing tools, you name it, we do all of them, and we spend a lot of money.
We've always been short on cash in the early years. We experimented with every new medium. You want to be the first to really own a new medium. We were very early on podcasts. We were very early on Twitter. You want to be able to exploit those medias before everyone else rushes in and things get expensive. So we were constantly tinkering and experimenting.
Obviously, you're growing your company, so this is kind of a strange question from the audience, an anonymous question. Any plans to enter the venture capital industry after completing your respective careers? I'm going to position that slightly differently of saying that you've never had to work with VCs, so that's a different world, and you've had to work with a bunch of VCs. Has that turned you on or off from the industry?
We're actually invested in a fund of funds. So we're actually kind of in the VC world already, actually.
So there's making investments. I don't know if that's the same thing as being a venture capitalist. I often think it's sort of like being a weather person. You can be wrong all the time and it's totally fine and you still get paid. That's cool. And so that wouldn't stink, and they seem to do really well financially. But my co-founder and I have started another company in addition to Cabbage, so it looks like that's not going to be on my roadmap for the
kind of busy.
long-term future.
You're a little busy.
Yeah.
What are the metrics that you think about in terms of growth for your respective businesses?
Metrics? What metrics do I think about for growth? I look at growth of paying customers, international customers, and money in the bank. Those are the 3 numbers I look at.
We're launching a lot of new products right now at Cabbage, and so there are 2 different ways we're measuring growth. On our core business, we're looking at revenue, basically per customer, as a percentage of their lifetime value. That's an important metric for us. And then for the new products, because it takes time to generate revenue from new products, we're looking at adoption. We want to understand in our current customer population how many of them are adopting these products and what are the cross-adoption rates across products. So it really depends, I think, on where you are in the stage of your business, what metrics are important.
So one question I have is, obviously one approach to growth is acquisitions. Cabbage, I believe you just recently acquired a company called Radius Intelligence. I think you've had a couple of others over the years. I don't know, have you had any acquisitions?
We've made a couple of recent acquisitions.
How do you think about growing through acquisitions and then how you finance those?
For us, we look at smaller acquisitions because customer experience is kind of our mojo. We can't really think about buying something really big and bolting it onto MailChimp. We want something that we can take time to integrate and make it really great. And maybe also considering acqui-hires is a good thing for us, but we don't go too much more beyond that.
First, I have to correct something I just said. I meant customer acquisition cost relative to lifetime value, not revenue. That was dumb. Anyway, English major. So I think when we think about acquisitions, we're not looking at things. People keep asking us, oh, why don't you buy this other lending competitor? Because they're really a pain for you, because they're in the public markets and they're messing up your comps. And while that is super tempting, it's not really accretive to our core business. We're looking both at the last couple transactions, and one we'll announce soon. It's all about getting access to new technologies, to new data sources, to engineering talent or to data science talent that we need. So it is acqui-hire-ish, but in a couple of places we've actually gotten platforms that we really needed. So it's very much not about getting more customers in this case. It's about getting more tools that we can use to deploy for our customers.
Question from the audience. Did any of your family members participate in the early days of your companies? Did you ever borrow either money or talent or time or sweat equity from your own family?
No, I got lectures about how crazy I was from my family. This is never going to work. What is this monkey thing? Why can't you be more like your sister?
What does your sister do?
She's a vice president of marketing for a liquor brand.
Oh, wow.
Yeah. If I could just be more like her.
There you go.
No.
Nobody from my family could have invested even if they had wanted to, but no, we didn't have anybody working. And my parents still think I make web pages for a living, and I never have made a web page before, but that's what they think.
What are some of the? Obviously we have a lot of early stage founders here. What were some of the things you really got right early on in the company, and what were some of the things you really got wrong early on that you wish you had changed in hindsight?
For us, I think a lot of people thought I was crazy to focus so much on the MailChimp brand instead of, growth or funding. But I thought that was really something that was going to pay off in the future. And I'm really glad it's just paid dividends for us. It's just so well known all around the world. And so that was a little bit of a different approach that we took that I know that we got that one right.
I think what we got right was a decision that we made early on to require our customers to give us real-time access to the data they use to run their business. If they weren't willing to share the data with us, then they couldn't get a loan. That was just all there was. And so many people said we were crazy. You shouldn't do that. You should have these manual processes for customers. They're not going to want to share their bank data with you. And we're like, too bad, we need the data. And it turns out that was a really important fundamental decision for our company and is what differentiates us from many others in the space. So that was a really fortunate decision that we made. And I think when I think about mistakes, it is back to data as well. I don't think we, from the very beginning, made good decisions about the technology and tools that we're going to use to store and use data. And 10 years later, we're now revamping that entire data infrastructure so that we can better support the needs of the business. And I think if we would have done that a few years ago or made different decisions earlier on, and to be fair, the tools and technologies that we're using today weren't available then, but I still think we didn't do it right. And so I wish we could go back and do that differently.
I don't know if you had this, but a lot of VCs who visit us in the early days they were really just saying, why just small business? Why don't you grow up into enterprise?
Oh my
Serve the
God.
enterprise as well. And it was counterintuitive to them. And we said, no, we are all in on small business. And that's something that we got right that every VC told us we were getting wrong.
And you get so many dumb questions from VCs. No offense if there are VCs in the audience, but
No offense.
I mean, how many of you have ever run a small business?
Small business
So
owners?
good, that's
Oh,
awesome.
good.
So the question that we had from venture capitalists, which getting back to the earlier question of would I ever be one, they said, oh, why does a business need $1,000 or $5,000? Don't they all have that money in their checking accounts? And we're like, you have no idea what it's like to be or run a small business. So it's really interesting, just the perception, being different. And there are so many companies that say they serve small businesses, but they're really serving large enterprises, just not Fortune 500 companies.
Yeah, they don't know that $1,000 could be their marketing budget or furniture and maybe lunch.
That's right.
Depending. Yeah.
Well, actually, I mean, let's talk a little bit about small business. I mean, this is one commonality you have between us. You're targeting smaller companies, sometimes mid-sized companies. I mean, what makes that market unique compared to selling into large enterprises?
Small businesses, they're the ones using the product. They're the buyer, and they're the ones so it's a very self-serve model for us. They also buy like they would buy a consumer brand. So I tell my employees we're maybe a little bit less like an enterprise software company like Salesforce. We're a little bit more like maybe a consumer brand like Nike. And so this is why you see a lot of our marketing and our branding done the way that it is. It's where we have to sort of build like a B2B brand, but sell like a B2C brand.
Small businesses don't congregate in one place, so it's hard to find them. It's a lot more like marketing consumers. So I think that's one challenge to find small businesses. And they're bombarded by so many different products and tools, yet they're so vital to the economy. And I love to tell these stats, but many of you know this already, but they're responsible for half of our non-farm GDP and 2/3 of all new jobs. And if you look at small businesses in total, there are 30 or 32 million small businesses, and 85% of them have fewer than 20 employees. That number's a little off. Paul's probably going to correct me later if he's in the audience, but it's something like that. So it just means they're very, very small businesses, and people don't think of small businesses as being that small, but the preponderance of that 30 million small businesses have fewer than 5 employees even.
30% of them are dead in 2 years, and 50% of them are dead
Not
in 5 years.
actually dead. They're breathing.
But they
just
fold.
don't have a business.
They fold.
They're cadavers.
It's really
That's right.
stressful to
Cadavers.
run a small business. It can kill you.
Yeah. But what the churn rate means,
Yes.
so many new small businesses are coming into the market every year. Your product has to keep evolving for that new wave. It's like when we started, it was all about RSS. RSS was the thing that was going to kill email, and we had to integrate very well with that. 2 years later, it's all about social media. 2 years later, it's all about mobile. There's always these new waves. So if you serve small business, you've got to be ready to adapt and change really fast.
Moving over to corporate governance, your board's a director. How did it come together? Who's on your board? What is it composed of? And then how do you I don't even know.
He doesn't even have a board.
I don't have a board.
Jerk.
I don't know.
It's just
What
you.
is that?
Stop gloating.
What do they do? I don't have a board.
And how many members are on your board?
6 or 7. I should be able to answer that question, shouldn't I? 7.
One of those people probably doesn't show up on
so we're really investor heavy. So it's just as the nature, we've raised a lot of money. We have one independent board member, Lori Hodrick, who's a professor at Stanford, I like to talk about because she's super wonderful and really smart, but the rest of our board members are investors.
And for Ben here, not having a board, I mean, there's clear advantages. Okay, you can make decisions or whatever. You're the one making the decision, but don't you lose out on some of the advice or some of the strategic setting that comes from a group of people who show up occasionally, who aren't in the day-to-day operations of the business?
No, I found that as we've grown, we've built a reputation where if I want advice, I can get it. People are willing to talk to us. I would say that there was a time when I thought about getting like an advisory board set up, and I got a really great bit of advice, actually. They said, why don't you spend a few years really like focusing on building a culture where your own executive team has no fear walking in and telling you when you're wrong. That would be your better, more immediate advisory board. And that has worked really well for us. So it's not like, I don't have a board, so I'm like some kind of a ruler of everything. We're very collaborative with our executive team.
And what about for you?
I think people have a misconception that board members are really engaged all the time, because the fact of the matter is they don't wake up every day thinking about your company or thinking about you. They're on multiple boards. They have day jobs. They have lots of other things going on. Most of the time, they pay attention when there's a problem, something that requires their attention. Not because they're bad people, just because they're busy like everybody else. So sometimes boards can be useful. It's nice sometimes to bat an idea around a table and get other people's perspectives. But there is a lot of time that goes into preparing for it, not dissimilar from being a public company and having to have quarterly analyst, conference calls and explaining what you're going to do next and setting expectations and targets. Those things happen. It's just, you have more of an ability to sway the audience, I think, in the case of a board than you do with the public market.
One of the hacks that we had in our early years was we had a coffee hour at MailChimp where we would pay speakers to come in. And that actually got a lot of sort of bigwigs and advisors that we would want to get advice from to just come. They would do a little chat, an all hands to talk about whatever topic they were experts at. And then we would just hold them a few minutes later and just get the advice that we wanted. You pay them a little bit of money for speaking, and that's it. And over the years, a lot of them actually became employees because they just sort of developed this relationship and they value. So, yeah.
You've been at this a long time. You've been at it for 2 decades. You've been at it a decade. How do you feel at this point? I mean, obviously there have been ups and downs.
Feel good. You're like that private equity people, like very healthy. But I'm not going anywhere.
I think obviously huge success all the way through, so that helps propel you forward. But what do you think about doing new projects? How do you do? Is this just going to be the legacy for the rest of your life, or how do you think about this far into the company?
I'm not a parallel or serial entrepreneur or whatever it is. I pick one thing, I want to win, and I commit. So this is my passion, this is my journey, this is my kung fu. I'm here to master it. Yeah.
We've decided to win at 2 things.
And what's the second thing?
The second company is called Drum.
And what do they do?
Drum aggregates fractionalized demand for a sales force, allowing a small business or any business at all to stand up a sales force faster than they could stand up or launch an AdWords campaign. Connecting businesses with customers through a network of salespeople that are comprised of the gig economy and independent contracting workforce. It's a lot of words. So imagine like a human affiliate network, so to speak, but more personal than that. We're launching later this month.
Another question from the audience. How do you balance external expectations, in your case maybe investors, in your case might be advisors, your clients or something like that, versus the internal expectations of your team? And do you ever see a situation where the team might want to do something maybe because it's interesting, or think your developer team or your technical team or your finance team wants to do a new product, but it doesn't meet the expectations of the market?
For us, there's not much of a balance. It's just whatever is best for the customer is what we do. It's helpful that we don't have to also balance that with investors or advisors. We can just keep customers as a North Star. We don't really have too many long discussions about that.
I think it's less about the what for us than it is about the how. As we've gotten larger and we've hired people who have more experience, they tend to also be a little more risk averse. And so they want things to be perfect before they get into a customer's hands. And sometimes that can take too long, and we need to be willing to take more risks. And I think, that aversion to risk can really be a hindrance. Obviously, we're talking about people's money and people's personal data, so you have to be really careful with all of that. But it's okay if the drop down is, backwards for a day because we did something really fast, and that's something hard for people to do. We actually launched a new award internally, a failure award that...
you can say the real name on it.
We called it the Fuck Up Award, but we got this anonymous email that it was offensive, so we're going to change it. But anyway, the young people today. So I'm just teasing. Get off my lawn. So anyway, I think it's really important to recognize and honor failure, and for everybody to talk about it and to own it, because it really is important to fail.
We have 1 minute left, so a quick, tiny lightning round. What is the most important advice you would give to a founder in the audience today thinking about how they should build their company?
You better have some grit, and you better focus on the customer. Talk to lots and lots of customers.
Get a co-founder. I think it's really important to have a different point of view.
Awesome. Ben, Katherine, thank you so much for joining us. Thank you all for the audience for coming out.